Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Ben Rogoff, manager of the Polar Capital Technology Fund. Hi Ben.
Hi.
So we've just heard from you in the Morningstar Investment Conference and you gave the outlook for the tech sector. I suppose we better start with the big three, Facebook, Google and Amazon. What are your thoughts?
Well, we like them all. All huge beneficiaries of cheap compute, beneficiaries of the cloud, and of course the proliferation of smartphones that, 2.2 billion people in the world have smartphones, and all of those people are fair game to each of those customers. So, running through them each in turn, Google obviously dominates advertising, online advertising, and $70-odd billion being done today, and lots of apps that people use all the time. I was looking at some stats recently, something like 90% of all the mobile clicks in the UK now are coming from Google, and so Google is becoming a kind of near monopoly really in helping people find information and transact on the internet. Facebook, very controversial stock when it came public, but actually demonstrating the value of Metcalfe's law, where the larger the network, the more people on the network, the more valuable the network. So 1.6 billion people now, monthly users, and more than 1 billion every day. So 1/7 of the world's population is coming onto Facebook every day. It's a fairly staggering stat, and it kind of goosepimply moment. So companies monetizing slowly but surely through the various channels, Facebook, Instagram, and over time WhatsApp and Oculus Rift, which will be their virtual reality product that's coming soon. And then Amazon, wow. Amazon, amazing, biggest active bet in our portfolios. Company today dominates two huge categories. The e-commerce category everyone knows about, growing vastly faster than e-commerce. E-commerce is still a teens percentage of overall retail sales. So years of growth we think ahead. And then they have this kind of Prime offering which demonstrates the network effect. More people every month are joining the Prime, get instant delivery the next day, and that's driving more sellers to the network, and then more people and more sellers. So the network is becoming enriched by Prime. And then there's the whole cloud business. So Amazon Web Services is their public cloud business. Today is really dominating the cloud, and that business will be probably the first enterprise technology company to make it to $10 billion within 10 years. Faster than Oracle, faster than Apple, and really dominating the cloud. And we're hugely excited about the cloud because the cloud's going from 15% of compute today to well, we think 30, 40, 50 onwards over the next few years. And so really nothing to lose and everything to gain from a new cycle.
Of course, it's not a portfolio of 3 stocks. There is more in the fund.
For sure.
And you have talked just now about new technologies. And for a lot of people, that may mean, okay, is he going around looking at these small startups? But that's not what you mean by it. Not necessarily small, but new.
Yeah, well, I think the most important thing for people to understand about how we run our portfolio, how we invest, is that we're growth-centric. So we'll ultimately go where the growth is. So what's staggering about Google is this is a 70 billion plus business on revenues and still growing faster than most companies. So I think we're kind of market cap agnostic. We're really just going for growth at values that we can make sense of, that we can justify. And so we do find small cap ideas, but right now we're at relatively modest percentages. And when you think about the internet as being the most fertile place for us to invest, the real beneficiary of all this cheap compute, really we see those big franchise I would say pseudo monopolies now being built, and it's really kind of making it very difficult for small caps. And so last year, 80%, or I think 82% of all the incremental spending that went online in the US was captured by Facebook and Google, which makes life difficult for small caps. So we will buy small caps, but they will have to be niche companies. What we're really excited about are companies that have the potential to transform large market opportunities, and they tend to be mid and large cap.
And these, of course, are those disruptive technologies, aren't they, that everyone's talking about. Stocks that you may not traditionally think of as tech. They may sit inside commerce, they may sit inside services, but actually are experiencing huge growth opportunities because of the way that they are digitalizing businesses.
Well, that's a great way of putting it. So this is we are digitalizing, or that's a horrible phrase, isn't it? Much of the global economy, and users love it. Ultimately, the smartphone is the vehicle, the vessel for this change, and the cloud being the back end of it. So yeah, it's always been a kind of cat and mouse thing with index people about what is and what isn't a tech company. But I think it's so much more difficult today, because in the past it would have been newfangled technologies coming along, and they're too small for the index people to understand them. And today it's all about, as you say, digital transformation. So Amazon, for example, is not considered a tech company. It's a retailer. And so that's why it's our largest active bet in both of our portfolios, because it isn't in the benchmark. And very recently, eBay went into the benchmark, incredibly 14 years or whatever since the tech bubble when it went in. And it took that long for the index people to get around to reclassifying it. So yeah, I think there's a huge disparity or mismatch between what is and what isn't a tech company. So we are looking in retail e-commerce, where a lot of the companies are not. LinkedIn is not considered a tech company, but has reinvented the recruitment market. TripAdvisor is not considered a tech company, but it's reinventing the travel market. So it's exactly that blind spot, really, that vacuum that we're hoping to expand into.
And of course, as an active manager, you can do so.
Well, we do, and then so in our UCITS portfolio, we're roughly 2/3 of the book is active. We don't build a portfolio relative to a benchmark, particularly at a time where the benchmark feels, I would say, troubled by the change that the focal point of compute is shifting from the enterprise to the internet, and web scale companies like Amazon and Google and Facebook are benefiting really disproportionately from price deflation and 2.2 billion people, whatever the number is, of potential customers. And so unfortunately it takes time for the benchmarks to catch up with that dynamic. And so we don't build the portfolio based on the benchmark, and that's reflected in our active share.
Ben, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.